So you ever wonder why, as realtors, we talk about the importance of the pre-approval process, or just the fact of just what even goes into a pre-approval for a loan? So we're going to talk about that and much more today with a special guest. So stay tuned for what we have for you today. Good day, everybody. Welcome to Hill Country Real Estate with Cody. I have got a special guest here today with Jason Layh from
Edge Home Finance.
Edge Home Financing today. He's one of my preferred lenders of what I used to, but he's also a real estate agent as part of the Layh Group too as well. And a lot, guys, stay tuned to the end of the video because we are both going to do a prediction of how we think interest rates are going to end up in the year. Again, there's no telling, but we are going to do our prediction this year.
Sounds good.
So Jason, thank you for being here with me today. I really appreciate it.
No problem.
Yeah. So as things go, and we always in real estate, we always talk about the importance of like through the process. But as you know, as a real estate agent, most time when home buyers come looking, they start looking for a home and they don't have a pre-approval letter.
Yep.
And they find this home that they like, and you try to explain to them, no, you need to go through the pre-approval process first, and they ask you why. Explain the importance of that.
Well, there's nothing worse than somebody finding a home that they absolutely love and not being able to afford it. So a pre-approval is designed for a buyer to have a budget to go and shop for a home. It also is a document that shows that that buyer, that borrower, has gone through the process of a lender looking at their documents, looking at their income, looking at their debts, looking at their credit, and being able to say that, yes, you qualify in for at least the introductory piece of it looks like you'll be able to afford this home. It also lets a seller know that this person that's providing this offer can afford to buy their house, so that everyone is entering into a contract that most likely will be able to close, and the seller will be able to get their money out of the house, move on to their next project, as well as that buyer get into the home. So it's really important for your budget, just to be able to make sure you're shopping in the range that you want to be in, and not falling in love with a home that you can't actually buy.
Now, to add on to that, here's a question I get quite a bit. Just because you're initially pre-approved for, we'll say $400,000, does that one mean that you should be shopping for a home that's up to $400,000? And two, when you get ready to close, you're going to be able to get that $400,000 loan?
So no, that does not, because you're pre-approved to buy a certain level of home does not mean that you should buy a certain level of home. And this is a discussion I have with all the borrowers, is that the ratios that are set by Fannie Mae, Freddie Mac, Ginnie Mae are 50% of your income, and sometimes more than that, for what can go towards your house payment and your other debts. Now that doesn't mean that you should be able to do that or want to, because it doesn't mean you can actually afford that and not be what we call house poor. So usually when you do a pre-approval, we've gone through the process enough to make sure that you can afford that, and it will get you through to the closing process. So you can, but it doesn't mean you should. Does that make sense?
No, it absolutely does. And when y'all factor in for that pre-approval process, do y'all factor in like the taxes in a certain area, the insurance, to make sure that they can afford that monthly payment? So
as a loan officer, we look at what is called PITIA. So I know most people know what PITI is, what's principal, interest, taxes, and insurance. And when we say taxes, that's your property tax on the house. Okay. And then insurance is for the insurance on the home. The A is for homeowners association fees. So most homes are going to have an association of some sort that you have to pay for. It may not be escrowed, but we do count that as part of that house payment. Does that make sense?
No, it makes perfect sense, because essentially what you're trying to do as a mortgage lender, make sure that you're protecting the buyer, that they don't get in too far over their head and become home poor, right?
Exactly. So and when I say a home poor, the catch that you really want to watch is that when you're calculating your house payment and what you should afford, is you got to expect the unexpected. Something's going to go wrong. You're going to have a car breakdown. You're going to have hospital bills, doctors, stuff like that. Something's going to happen, and it always does. You want to make sure that you're protecting yourself to a level that you can afford those emergencies. Have that emergency fund above and beyond what your house payment is.
What's ironic about that, it always happens at the worst time too.
It does.
Right?
Absolutely.
Now with that, when you're looking at that, like when someone comes to you for pre-approval, it's like, what documentation or what documents do they need to be prepared to have?
So that does vary per borrower, but in general, in my process at least, I'll send a link over, they'll go through an application process. In my system, and pretty much every loan officer system is gonna automatically queue them for provide these documents. I always ask my borrowers not to do that, to fill out the process, let me review it, then let me get with them on what they need. But for a regular W-2 type employee, so a salary type person, you're gonna need the last 2 years W-2s, the last 2 years pay stubs, your identification, so like social security card, driver's license, something like that, and then your bank statements for the past 2 months. And then one last thing is gonna be your last pay stub as well. Now I ask for not just your W-2s, but also your pay stubs for the year end, because of what we call variable income. So salary is 40 hours, period. So anything less than that is gonna be what we consider part-time. Even if it's 39 hours every week, it's still part-time. You have to have that 40-hour mark every week. So the pay stubs for the past 2 years helps me also calculate that variable income. So if you have commissions, if you're not at 40 hours every week, if you have any bonuses, overtime, all those things. And we've got to look at that history of 2 years to show this is the amount of money they make and can expect to make for the next 3 years.
Now, what if someone either owns their own business or they're an independent contractor, they don't have the W-2s?
So in those cases, you're gonna have to provide your tax returns for the last 2 years, because that's gonna have your Schedule Cs on there. And so we can then calculate your income based off of that. Now, if you've been in business for 5 years, we actually only need 1 year.
Okay.
So.
Now, as we also look at the pre-approval and everything else, is like, you hear a lot of people like say, well, my credit score is 800 and something, or my credit score is 600 and something. What does the credit score influence? And what's a good credit score, and what's a credit score that needs to be at least at minimum above to get a home loan?
So different programs require different things. So we'll start with the minimum. So everybody hears that the FHA has a lower allowable credit score, which it does. So your minimum FHA in most cases can be 580 to do the 3.5% down. Now, a lot of people don't know that you can still get an FHA loan below 580 credit score, but you got to do it 10% down or more. That's number one. Your conventional loans is going to be a 620 credit score or better. Your best pricing for your interest is really going to be in the mid 700s. That's kind of where the sweet spot is, where you'd like to be. Now, credit has to do what we call a line level pricing adjustment. So your cost for your interest rate, or the interest rate that's the sweet spot for you, if you have a lower credit score, that interest rate's gonna be higher. If you have a higher credit score, your interest rate's gonna start lower, and then you can pay points or whatnot to get even better rates. Does that make sense?
Yeah, explain to them like paying points to get a better credit score is like, what does that mean? Because like when you look at rate buy downs, and you know this question was going to come, because everybody because right now we're looking at interest rates, and you see like the new home constructions have rate buy downs to 4.99, even 3.99, and you see 2.1, 3.21. You're seeing all this stuff. What does that mean?
So you got two different types of rate buys. First is what we call points. So if you're doing a 30-year fixed mortgage, and that can be VA, USDA, FHA, conventional, whatever. A permanent buy down, or points, is where you're basically prepaying interest in a way to get a lower interest rate on your loan. So, and it's really a balancing act, because what you look at, or what I look at, is what we call par rate. So as a borrower, you're gonna have what is your par rate based off of your financial information from your, and it goes through your credit score, it goes through your liabilities, your income, your job history, your address, as far as how long you've lived in an address, all sorts of matrices that give you that rate. But once you have that rate that's at a par rate, that means that it doesn't cost you anything to get a rate. Say that's 7.25. Now, to get you to say 6.75, you can have a cost for that rate, or that half a point difference, of say $2,000. So you pay $2,000 at closing. Now you have a 6.75% interest rate for as long as you keep that loan, and that's what it costs you. Now you always got to weigh that with what the break is on the payment. And I always go through and do a calculation for my borrowers, like, okay, to get you to this interest rate, say 6.75 or 6.5 or 6%, it's costing this amount of dollars. It's going to save you $50 a month or $75 a month. And then you're able to do that and then divide it out and say, okay, it's going to take you this many months to to make that buy down make sense. So 24 months, 36 months, 18 months, whatever it may be. So those are what you want to look at. So it's that par rate is the key. And then you move off the par rate to see what's going to cost you to get to the interest rate that you want to be at.
Now, when you hear a lender say, in order to buy down this 1 point, it's going to cost you X amount of dollars. How is that figured, and what does it mean, like 1 point?
So a point is 1% basically of your borrowed amount. So if you're buying a $200,000 house and you're putting $50,000 down, 1 point would be $1,500. Does that make sense? So 1% is $150,000.
But does that mean that the rate moves down 1%?
It doesn't move down 1%. It usually will move down about 1/4%. So it varies by lender. So I've got some lenders that have their sweet spot of a rate. So say that your par rate is 6.5. They may have a lower cost for you to go to 6% than what it would be for you to be at 6 1/8%. So a point does not always technically get you a full point on the interest rate. And it varies by lender and it varies by pricing. So it's really hard to explain. And the best way to do it is to go through and figure out your pricing, and we'll price out the best lender for your deal. And then we say, okay, this is what it can cost you to get an extra 1/10 of a point or 1/4 of a point or a 1/2 a point or whatnot.
And essentially, what you're doing as a lender, you're trying to find that sweet spot, right?
That's right. That it costs the least amount for you to get to that best interest rate.
Okay. Now, another question I have is like, I get this quite a bit. It's like, well, I'm not really looking to buy until June, July. So we're right now, of course, we're in March. Why should they get a pre-approval, or how long does that pre-approval typically last?
So pre-approval technically will last about 30 days. And that's because after 30 days, we usually have to re-verify income because you're going to have another pay stub.
Okay.
More bank statements, cash moving in and out, things like that. A credit run, a hard credit pull will last 120 days. Now, keep in mind that if you contract on 119 days, you're going to have another hard credit pull before to keep that applicable. But if you're going to close within 120 days, that one credit pull will do the whole thing for you. Me, typically, if they're shopping for 6 months, I'll do a soft pull from them. And that way I obviously get their credit score. I still get all their liabilities. But in order for that to qualify through a lender, you're going to have to do the hard credit pull. So I can get all the information that I need and say, here's your budget, here's your shopping point. Before you make an offer, we need to do a hard credit pull, so it's a strong pre-approval. But this is a good budget for you because I still have all that information.
Now, when you do a soft pull, how much does that affect your credit score?
It doesn't at all. It's just like an insurance company that pulls your credit because your homeowner's insurance, your car insurance, your rate's based off of your credit for most of those insurance carriers out there. So they do a soft credit pull, and it doesn't hit you at all.
So that's why I get all those credit apps coming in.
That's right.
Trying to get me to get credit cards and everything else.
Exactly.
So that's just from a soft pull as well.
Yep. Now here's another quick little side note. There is a site called optoutprescreen.com, and just for any of your borrowers or buyers, if they go through on that site, it's absolutely free. It keeps them from what we get called trigger leads. So when they do that hard credit pull, if you don't do that, you get like 300 phone calls in about 2 or 3 days. That takes about a week to go into effect, but if you do so, then you don't get all those trigger calls.
That's interesting because I just had that happen with a client of mine that, I mean, we just closed on the house, but they're still getting like 20, 30 phone calls from lenders a day.
Yep. So that's not your lender. So if you're using your lender and you get all these calls, don't blame your loan officer, don't blame your lender, it's not them. That is the credit bureau. So those credit bureaus take your information and they sell it off to other lenders that are buying those leads, and that's where they get all that. And that's why you get all those phone calls.
Yeah, so just remember that, don't blame your lender, look at the credit bureau.
Yeah, blame your realtor.
No, it's always the realtor's fault. I'll agree with you there on that. Now, when you're looking at mistakes that people do on pre-approval, what's the most common ones that you see?
My credit's good, I'm gonna go buy a car. So that's the biggest thing.
I know we had a client do that right in the middle, but he was right in the middle about to close on the house. Right before it closed on the house, I'm like, no, please don't.
So that, and some people say, you know what, I have a little bit of extra cash in the bank. I'm not gonna need as much as I thought, so I'm gonna go ahead and buy the car. It's gonna be cash. Same thing. Even though it's not dinging your credit, you're taking cash away that shows instability in your accounts. So that's the biggest thing with your pre-approvals. When you're going to shop for a house, keep the main thing the main thing. You're going to buy a house. Don't buy furniture. Don't go out and spend a whole bunch of money that you normally wouldn't spend. Live your life as you normally do. but don't do anything like exotic. Don't spend a ton on a new vacation. Don't go buy a new car. Don't open any new lines of credit. Even those 0%, hey, here's Best Buy, I can get me a new 85-inch TV, but I get it 24 months if I do their credit card. It's no interest, so it's no big deal. It's still going to ding your credit. It's another open line of liability that you don't want to do. So that's what messes up pre-approval. So don't go keep the main thing, buy the house, then make sure you can still afford the other things, then go out and do those things.
Last question before we get to our predictions. Explain the debt to income ratio. We call it DTI, but go into that.
So debt to income, there are actually two different calculations. You have your front end debt to income ratio, and then you have your back end debt to income ratio. Your front end is used primarily with FHA and USDA. And FHA is most common, and you've got to watch what your income is as a ratio to what that house payment is, the PITIA. Remember the principal, interest, taxes, insurance, divided by your total income. Now that front end ratio for FHA has to be less than 31%. So if your payment for your house is going to be more than 31% of your total income, you don't qualify for FHA.
Now, is that gross income or net income?
That is gross income. That's before any taxes or anything like that's pulled out.
Okay.
So that's super key. Your back end ratio is that same house payment, PITIA, plus any liabilities. And that can be credit card payments, loan payments, personal loans, other homes that you own, car notes, anything that is a liability that you had to pay on monthly, affirm payments, things like that. Those things are calculated as well. Now, it's not utilities, it's not your cell phone, any of that. Now, I will say that, but one thing that is different is the VA is a very different program. It's fantastic for our veterans. They don't go off of a debt to income ratio. They go off what we call a residual income calculation. And it's based off of all those debts, but also a percentage of your utilities and things like that. And it's real complicated, but as a veteran, as a VA loan applicant, they have a different calculation there that doesn't, you can have over that limit of what you would see with conventional or FHA and still qualify for a VA loan. So, but that's kind of DTI in a nutshell of what they are. Now,
what's ideal for a DTI?
Well, that depends on each individual person. Some people, if they don't have any other debts, they can go up to that 49.99% that Fannie Mae and Freddie Mac for conventional allow and be just fine. But it really depends. Most people, the sweet spot is somewhere in the 30s. That is comfortable to be able to make all your debts, have all your living expenses, especially as much as what eggs and stuff.
Now, is that back end or front end though?
That's back end. That's what I prefer to talk to my borrowers about, being somewhere in the 30s. Sometimes low 40s, but somewhere in the 30s is pretty comfortable. Now, I'm not saying that always happens. I've got a lot of borrowers that push that limit at 49.99% that you're allowed for conventional. FHA, you can go up to 56.99%. So you can go a little bit higher up there with your debt to income on that back end with FHA.
So interesting. Now, with that, so a lot of people, as I get pinged on about interest rates, well, the Fed just cut rates, the Fed just cuts rates. You and I have this discussion all the time. Because it's explain that and what it influences on the mortgage markets, or how does it influence? Because the mortgage interest rates were down to, there were people getting the 4s of August of last year.
Yep, I locked a VA loan with a refinance that they bought a house in January of 24 at 6.25, and we hit that sweet time in I think it was the first week of August, and I locked them at 4.99% on a refinance for VA, and we haven't seen that rate again.
Yeah, the Fed. That's the point. The Fed's cut rate, and then all of a sudden the rates shoot up. What happened?
It was a week before the Fed adjusted rates is when I locked that loan. So that is a huge misconception, is that mortgage rates are going to follow what the Fed says and what they do. So whenever they drop interest rates by 0.5 point like they did last September, or 1/4 point like they did, I think it was in October and December, that automatically mortgage rates are going to come down. In fact, the actual opposite happened. So I like to say that mortgage rates follow not really what the Fed does, but what the Fed says they're going to do. Because your mortgage rates follow the 10-year Treasury bond market. So that's what you're looking at. So if you want to watch for interest rates, watch the bond market. because it's a prediction of what inflation is going to look like in 10 years. And for whatever reasons, that's where the mortgages kind of follow that line. And it's usually 2.5 to 2.75% over what the bond market's at, is usually right around where a conventional loan is going to be for the interest rates. So that's what you watch. Now, the interest rates have gone up more the last several times that the Fed's changed their rate. And a lot of that's because of the unpredictable future of what the Fed's going to do. In fact, I think it was in January when they came out and said, we're only going to do probably 1 rate cut or 2 rate cuts this year. Your mortgage rates went up.
That's everything in the panic mode.
Everybody freaks out. And like I say, I think that the way to look at it with the Fed and mortgage rates, in my little tag that I like to say is that mortgage rates like to follow the speculation of the Fed. So depending on how nervy the Fed is and what they're thinking they may or may not do, they're not sure they're going to cut any rates or whatnot, mortgage rates are going to be kind of fluctuating up. If they're real solid, like, hey, we're going to be cutting a lot of rates, everything's looking really good, unemployment's looking where we want to, CPI is around 2% where we're targeting, that's going to look better for mortgage rates. So, and also you got to watch the stock market, because if things are not as assured in the stock market, investors are pulling money out of the stock market and they put it in the bond market because it's a more secure investment tool. Yeah. So that helps bond prices. More people buying bonds, prices come down. The demand goes up, the price comes down, therefore mortgage rates also come down. I know that's super complicated. I hope that helps.
No, that helps. That helps quite a bit, because I mean, you and I, we talk a lot about where I place money, and then that one bond is, of course, I've just stacked up on that bond.
Yeah.
Because I see what's coming up in the market, which goes right into the predictions and everything else. Because where I'm seeing that the market is going, like people are like worried. It's like tariffs. People are like looking at the changeover, and there's a lot of instability in the market. I do think as we kind of continue out the year, I think we're about to see rates drop. It may not be substantial drops, but I do think this is my prediction. So y'all can watch this video at the end of the year. You can crush me if I'm wrong, but I do predict that we are going to be at least in the upper 5s by the end of the year.
My guess would be somewhere in the sweet spot between 5.85 and 6.05. That's my guess. Come December of this year, that's probably where we're going to sit at. I think that rates are going to go down and then they're going to go up. They're going to go down. I think they're just going to kind of slowly fluctuate down to around that range. Low 6s is probably my guess.
Okay.
Where we'll be at.
So, hey, look, everybody, you got it. So is it going to be Jason or is it going to be Cody? I want to hear what your prediction is. And Jason, most importantly, hey, thank you so much for being on here today. I said, guys, look, if you have any mortgage questions for Jason, I'll get you in contact with him immediately. That is very too easy. Please leave everything in the comments below. But also, guys, I mean, these videos and everything here are posters out there to help you out. So I do ask that you do like, subscribe, but also share this with somebody that's going through the home buying process, but also is trying to understand like the pre-approval process or just mortgage questions in general. So post your comments below, and I look forward to seeing you in the next video.
Y'all have a good one.